With the end of the tax year quickly approaching, it's really important that we financially prepare ourselves for it, whether that is by maxing out our ISA allowance or just being aware of the other allowances available to us. To help me delve into everything you need to know about the end of the tax year, I'm joined with Tim Paul, an accountant and financial content creator. Hello, Tim. How are you?
I'm good, Ola. Thanks for having me on.
No, you're welcome. Very excited to have you. It's the first time on the podcast, isn't it?
Yes, it is, yes.
Took me long enough, but you're here now.
I'm here now, that's all that matters.
No, I'm very excited to chat to you. And I guess for those listening that has not come across your content, I don't know how they wouldn't have, but in case they haven't, please introduce yourself to everyone listening.
Cool. So I'm Tim. I'm 25 years old. I'm a finance content creator on social media and also an accountancy business owner.
Yes.
So I run a practice helping kind of small, medium-sized and large businesses be more tax efficient, which obviously everybody likes because no one likes paying tax. So that's what I get up to.
No, I love that. And that's exactly why I have you on the podcast today, because you blink and the financial year is like literally coming to a quick end soon.
Yeah.
I know we've still got a couple of months, but it is very quickly approaching. But I guess one thing about yourself I really want to know is what inspired you to, one, start content and then also open up your own accountancy firm? Because that was pretty big.
Yeah, so I guess with the content, I guess my journey started in lockdown like most people probably did.
Yeah.
So I had a job lined up at Deloitte in January of 2021. I graduated in August of 2020. So I had like 6 months, 5 months of nothing to do.
Yeah.
And September was going by. I was doing nothing, literally like scrolling, and I came across TikTok and I started to see some like content creators that weren't just doing like dances and memes, but like that was all it was back then.
It
but
was.
So I started to see people talk about like making money, side hustles and that kind of thing, and I thought, well, I've had 3 years of an economics degree. I'm about to go into a career in finance. Maybe I've got something that I can share of value. So I made my first video and it was about lifetime ISAs, and it literally blew up overnight. I had like 200,000 people trying to contact me.
Wow.
It was literally like instant success. Success in my world.
Yeah, of course.
Of like having done nothing like that before. And then from there, I was like, this is like my moment. So like, I need to keep this momentum going. So I just jumped on it. Was making like 2-3 videos a day. Flew to like 400,000 followers within like the year, and the rest is history. Deloitte is no more, and I'm chilling, doing my own thing. And then towards the end of last year, I guess not at the start of last year, I set up the accountancy practice because obviously I was training at Deloitte, finished my exams, and I wanted to kind of do something for myself. And at like a bigger firm, you don't really get that opportunity to kind of speak to businesses directly. You're kind of just a cog in a machine. So I met my business partner. He had a similar experience to me. So we both decided to go in it together where we could kind of make a difference on our own terms.
Yeah.
And so that was where it was born, really.
And you're flying and you're only 25 years old.
Yeah, no, I know. 25, team of 4. It's crazy. Yeah.
And this is why I love to get people onto the podcast, because there's so many of us that are doing incredible things, and I think everyone needs to understand, or at least listen to people's stories to understand that they can also do that too. Because I feel like you look at someone who's a content creator, they might have like 400,000 followers like yourself, if not more now, and you're like, you think it's so out of reach, but then actually having you to speak to who's a normal person, who's doing very well, I think it's just so inspirational.
I'm definitely normal, actually.
Yeah, I mean,
nothing special about me.
You're in your like quarter zip jeans, fresh trainers, and clearly killing it. So thank you so much for joining me today. So I guess I've got a couple of quick fire questions to get you warmed up into the hot seat today. So one of my first questions I have to you is, what's one guilty pleasure you like to spend your money on?
Okay, guilty pleasure, holidays.
Okay.
I mean, everybody loves a nice holiday. For me, it's like I don't go like away that often, but when I do, I want to make sure it's nice, 5-star only.
Okay.
Okay. But it's like when I always feel like when I come home, it motivates me because I'm like, the next time I want to go to somewhere even better and stay somewhere even nicer, and it's kind of like that motivation for me to like keep pushing.
Yeah.
So when I'm in the cold winters and the rain outside in the UK, I'm thinking I'll be Dubai, Maldives in a few years. So that's definitely one thing. The other thing is like I got a car, a nicer car. So I got myself a Tesla last year.
Oh, wow.
And that was like the first big purchase that I kind of made that was like purely for pleasure.
Yeah.
Like not throwing money away, but like it was all down to just me wanting to do something, like treat myself essentially. And I do think that like with budgeting, you have to make sure you allocate money for you,
Yes.
not just for your future self. Otherwise, it's not going to be sustainable. So
Yeah.
those two things, I would say, are my pleasures.
I'm here for it. Firstly, with the Tesla, I
Yeah.
did hit my car today, so I don't think I'm worthy of a Tesla just yet. But
Oh, gosh,
yeah,
yeah.
I would love to be able to treat myself to like a really nice car eventually. And then holidays, I think everyone knows on the podcast that I love a holiday. I mean, I love traveling.
You're away in Jan.
Yeah,
Yeah,
I
how
was.
that?
Needs must. Yeah, very good. I needed some sun.
Yeah.
I needed the vitamin D. It has set me up nicely for the year ahead because now I'm just like, oh, positive vibes. But where has been your favourite holiday destination?
It's got to be Barbados.
Oh, wow.
Yeah, we went out there for my mum's 60th a year and a half ago. And yeah, it was amazing.
Yeah,
Best
it is
beach.
beautiful, isn't
Yeah,
it?
yeah.
Oh, now I just want to leave the UK again.
I know.
And the second question I have for you is, what has been your greatest financial achievement?
That's easy. So buying my first house with my partner.
Yes.
When we left uni back in 2021, that was literally all we talked about. Like
Really?
saving, we want to buy our first place, and it took about 4 years.
Okay.
But we managed to do it last year. Still not moved in yet because it's a reno, so it's,
Yeah.
it's taken a lot of work. But to be able to do that at 24 at the time, that was a big achievement because it's so difficult now to get on the ladder, and so many people struggle when like the average age of getting on the property ladder is like 34.
Yeah.
So to be able to do that in my 20s even was a great achievement. It's one thing off the list I
Yeah.
can tick and say, okay, on to the next.
Yeah, 4 years.
Yeah.
Fair play. I'm still grinding out here.
I mean, the one thing I would say is doing it with a partner makes it so much
Yeah.
easier. Like it could literally have taken 8 years if I
Yeah.
was doing it on my own. So yeah, having a partner to do it with who's
Yeah.
also as like disciplined with like saving as you are really, really helps.
Yeah, I can imagine. Guys, if anyone wants to buy a house with me, let me know. No, and I love that. And I guess obviously today on the podcast we're chatting about the end of the tax year,
Yeah.
everything we need to kind of know to be financially prepared for it, right? So my first question for you is, when is the actual end of the tax year?
Yeah, so the tax year runs from April the 6th until April the 5th every year, and it's a continuous cycle. So a lot of people get confused. They think it's Jan to December.
Yes.
Because that's how kind of everything works in this country. But tax-wise, all your taxable income, it's from April the 6th to April the 5th.
Yeah.
And so that's how you're taxed, and that's how your income is kind of categorized, on an annual basis.
Yeah. And it's so funny because I literally feel like the end of the tax year was like 2 weeks ago, and now it's like in a
It's
few
coming up
months'
again,
time,
yeah.
very quickly. And literally right after we've just paid our big, well, for me, quite a fat tax bill.
I know, yeah. It's
But
hard
yeah,
out here.
it is,
Self-employed
Oh,
people.
It's not fun. It's not fun. But obviously, before we delve into how people can, I guess, financially prepare for the end of the tax year, it's really important for people who are listening who maybe don't understand how tax works, how the different tax brackets work in the UK.
Yeah, so we've got the main tax that everybody pays, whether you're self-employed or on a PAYE salary, is income tax.
Yes.
So from £0 to £12,570 on an annual basis, that's your tax-free personal allowance. You won't pay any tax on that income.
Yeah.
Then from 12,570 up to 50,270, you fall into the 20% band, which
Okay.
is 20% income tax, and that's the basic rate tax band, which most people in this country will be in if you're earning
Yes.
30 to 40k. Then it starts to get a little bit harder. So once you hit the 50,270 mark, up to £125,140, it's 40% tax.
Okay.
So from a business perspective, what we would say within our clients in our accounting practice, you start looking at like company cars and pension contributions to try and limit your income that you'd like take personally. And then once you hit the 125,140, at that point it becomes 45%, and that's one of the highest marginal tax rates in the entire world. So if you earn a lot of money in the UK, be prepared to pay a lot of tax.
Yeah.
There's just no way around it, unfortunately.
This is why I see so many of my friends, other people online, moving to Dubai.
Dubai is a hotspot right now, like huge hotspot. So many people that I speak to that have like a bit of wealth,
Yeah.
they all are going to Dubai.
Yeah.
Like seriously, leaving in the thousands.
Yeah,
It's-
and I'm not surprised. So the UK,
You can't blame them.
yeah, the UK needs to sort out this tax, honestly. But I guess, obviously, we're under Labour government
Yeah.
now. Do you think there'll be changes to the tax brackets as we enter a new tax year?
I very much doubt it.
Okay.
I don't think they would take that much of a risk because it will be a very polarizing decision, whichever bracket they go after. Whether it's because, I mean, most people will want them to go to higher earners, but if they go to higher earners, they could risk a lot of them leaving. If they go for lower earners, then, I mean, I guess that'd probably be the best thing to do. But will they do that and risk losing that tax money? Probably not.
Yeah, very interesting. I pray they don't.
They do,
so
yeah, I know.
we'll see. But I guess, obviously, like I mentioned, when it comes to paying tax, there are legal ways of avoiding paying tax. So as we approach the end of the tax year, what are the different tax allowances people should take advantage of before then?
So the main one will be your £20,000 ISA allowance, and
Okay.
this obviously falls into a few different ISA products. The main one, the first one, would be stocks and shares ISA. So you can invest up to £20,000 into a stocks and shares ISA if you're looking to invest your money. So me personally, I use my ISA for investing in S&P 500. I mean, most people probably know what that one is, but
Yeah.
if anyone that doesn't, it's the 500 top performing companies in the US. So like Apple, Tesla, Google, Facebook, those kinds of things. Then you've got your cash ISA. So for anyone that isn't maybe wanting to invest or feels like it's too risky, don't feel like that, because it isn't too risky. It's always good to do. But if you're not ready to, then a cash ISA is good, because you can get fixed interest between 4 and 5% at the moment,
Yeah.
whilst interest rates are still relatively high. So that's always a good option. And then you've got a lifetime ISA. So taking me back to my viral video.
Yes.
So a lifetime ISA is for anyone that wants to get onto the property ladder. You can invest up to £4,000 per year into a lifetime ISA,
Yeah.
and the government will add a 25% bonus onto your contribution. So if you're saving for 3 years and maxing out your lifetime ISA, you'll end up with £15,000, and £3,000 will be directly from free money from the government. So
Yeah.
it's really, really great if you want to get on the property ladder.
Yeah, thank you for touching on ISAs. Am I right in thinking that you can now open more than one of each type
in
of
each,
ISA?
yes, tax. Yeah, they did lift. There was a restriction where you could only contribute to one type of ISA in each like financial year.
Yeah.
But now you can contribute to all of them
Yeah.
in the same year. So I don't know why they ever had that rule in the first place,
No.
but it's good that it's gone.
Yeah, yeah. And do you think there's a particular reason as to why they uplifted that?
Just because it was annoying.
Yeah.
It's stupid. Like, why? There's no need.
No,
if you want to
so
invest
true.
and also save, and you want to do both within the tax wrapper, you should be able to.
Yeah, that is very true, very true. And I guess, obviously, alongside your ISA, what other tax allowances can people utilise?
So the other one is a trading allowance of £1,000. So let's say you have old clothes that you want to sell on Vinted. You can earn up to £1,000 outside of your kind of full-time job,
Okay.
selling clothes or whatever side hustle you choose, and that doesn't have to be declared on any tax return. The government can't get any of it.
Yep.
Once you go over the £1,000, of course you do have to start paying tax on it, but you get that £1,000 allowance every single year.
Okay.
So it's, if you haven't utilised it yet and you have things that you might want to sell, then it's great to do that before obviously April 5th comes.
Yeah, no, it's a really handy one to know, because I think people get confused when it comes to making extra cash outside of their full-time job. So thank you very much for clarifying that. And I guess another thing that I show on the podcast in ways of reducing your tax bill is to contribute more to your pension,
Yes,
right?
absolutely.
So what is the current pension allowance, and do you recommend people maximise that too?
Yeah, so the current pension allowance is £60,000 per tax year. Obviously, that does start to decrease as you earn. I think it's something over £200,000 a year. Once you
Okay.
earn above that, it starts to decrease. It is great too, especially when you're going into the higher tax bands, 50%,
Yeah.
sorry, 40%, 45% feels like 50%.
Yeah,
It might
it may as well be.
Exactly. So once you go into the higher tax brackets, it's good to start adding more to the pension. Obviously, as your income grows, I mean, the minimum is an 8% contribution, between you and your employer. So you have to do at least 3 to 5%,
Yes.
and your employer has to match that up to 8%. I would always recommend to try and do at least 5% yourself.
Okay.
And then slowly each year, maybe up it by a percentage point, and then get to a point where maybe it's like 12%.
Yeah.
And that's quite a comfortable amount where when you retire, you should have quite a good sized pot, because ultimately you can't really rely on the state pension. It's something like 200 odd quid a week
Yeah,
at the moment.
insane.
Like that's almost poverty at this point with the cost of living in this country. So you have to make sure that you put money into a pension, and if you're also using your ISA allowance too, then you're going to be setting yourself up for a good future and hopefully a good retirement.
Yeah, that is the plan, because I ain't retiring in the UK.
No, definitely not.
So thank you so much for breaking down all the different allowances. So I guess another question I have for you is, how can people maximise their contributions to their ISA before the end of the tax year?
Yeah, I think the easiest one that you could probably go for is if you've got some savings spare lying around collecting dust, like they do in most accounts,
Yes.
with point whatever % interest you get. Shove it in a cash ISA before April comes around, and at least you get your money working for you a little bit. You can get a decent interest rate, and obviously
Yeah.
it'll be protected from tax. So that'd probably be the first thing, the easiest thing to do. The other one is open a lifetime ISA, put a few pounds in, because you need that lifetime ISA to be open for at least 12 months before you can use it towards a house deposit and getting on the property ladder. So even if you're not thinking about doing it right now, it's great to do for the future. Get the clock ticking so when the time comes, it's there and it's ready to be used.
Yeah, no, thank you very much for that. And I guess with the cash ISA, a question I get a lot of the time is, what is the difference between an easy access savings account and a cash ISA? Is there actually any benefit to having a cash ISA over an easy access savings account?
Well, an easy access savings account is good, but obviously if you do earn any interest on that, it will be taxable. Shock. Whereas with the cash ISA, it's protected, and you want to make sure that you're getting like an instant access cash ISA if you might need that money in, you know, a few months time, 6, 12 months down the line. If you don't need it, then you could go to like a fixed notice account. Typically the interest is a little bit higher, but you might only be able to withdraw the money if you give like 3 months notice. So it's for anyone who doesn't need to have the money on hand to be like extremely liquid.
Yeah, no, that's really handy. And obviously you touched on the fact that our interest on our savings is getting taxed as well. At what threshold does the interest get taxed on our savings?
So it's £1,000 if you're a basic rate taxpayer, and then £500 if you're a high rate taxpayer.
Yeah, it's good to know, because I feel like, we're getting taxed out of our ears. Like council tax is going up, cost of living. I mean, inflation seems to be coming down, but it's still like, feels like life is still expensive. So I guess it's really important that people know that. And then I guess when it comes to lifetime ISAs, am I correct in saying as well that you have two types? You've got your cash lifetime ISA and a stocks and shares lifetime ISA.
Yes, there are two types. And the obvious difference is in the name. Cash ISA, or cash lifetime ISA, it will just be fixed. No investment. And then stocks and shares lifetime ISA, that can be invested and obviously grow a small amount, as well as getting the government bonus as well.
Yeah, and I think people don't actually realise that. So I have a stocks and shares lifetime ISA, which is invested in 2 ETFs and a couple of like individual stocks, and the capital gain on that has been amazing. So guys, if you're listening to the podcast and you're looking to save your first property, or you want an extra pension pot, I guess it's really handy to know that you can actually have capital gains as well as the 25% government bonus, which again, not many people know because we're not taught it. But obviously you mentioned earlier about the trading allowance that people can take advantage of. So I guess for people who earn additional income from their side jobs or freelance work, what else should they keep in mind before the end of the tax year?
I think the key thing to understand is how the self-assessment system works. So when you're earning, a decent sizable amount of kind of side income outside of your typical full-time salary, you need to know exactly how that needs to get declared. So all of the income between April and April, it gets declared. So let's say from April 24 to April 25 coming up, you earn however much. That then needs to get declared on a self-assessment by January 2026. And the thing that catches a lot of people out is payments on account, which I'm sure you know very well and all about that. So for anyone that doesn't know, let's say your tax bill comes up to be £10,000 and that's due by January 2026. You've actually got to then pay £15,000 for the pure fact of HMRC want a 50% down payment towards the next tax year at the same time as you pay your liability for your current tax year. So it catches everybody out because you wouldn't really know it unless you're specifically looking for that kind of information, and it's not that readily available out there. So you always need to make sure that you're essentially saving an additional 50% to what you think your tax liability is going to be. I don't even know why the system works like that, but it does.
They just want all our money.
Exactly, because it's annoying because obviously you don't know if you're going to earn the same amount the next year. So if you earn less, then you have to go through the system of hoping that you get the right rebate back, but you might not. So it's quite frustrating, but that's the way it works. So they're the kind of things that you need to kind of be aware of.
And coming back to payments on account, how do people find out that they need to pay that? Is it they get a letter from HMRC? Do they find out because they have an accountant? Typically,
if you're declaring it yourself, so your accountant would and should make you aware. If you're doing it yourself, then it will show up when you submit the self-assessment. It will then calculate it for you. And then when you log back in, once the calculation is done, it will show you a much higher number than you thought you would have to pay. So that's basically how it works.
So would you recommend people put away more than just 20% if they're a sole trader into like a tax account?
Yeah, I think it's a case of, obviously the good thing about the system is that when, April 5th comes round, you have 9 months before you actually need to pay that bill. So if you haven't got that extra 50%, you've got 9 months to budget for it, but you need to know that you've got to budget for that amount. So I think that would be the key, is just using that extra time that you've got to make sure you're putting the money aside, and then you've got no issues when January comes around, although it will still very much hurt.
It hurt me when it left my account, and I have a separate report for for it, and I'm like, that could have done me at least 4-5 cruises around the Caribbean. But anyway, we won't talk about it. I guess another question I have, is sole trader versus limited company, right? Especially as we approach the end of the tax year. Lots of people probably, as a sole trader, have earned maybe way more than they were expecting to in this tax year, which is amazing if they have. So when do people need to consider maybe turning into a limited company?
So I would typically always say once you're hitting about £50,000 in taxable profits is usually the mark at which you would want to start going to a limited company. So for sole traders, everything that you earn has to be declared at the income tax thresholds. So once you're earning that £50,000 and above, it's 40% tax. There's little that you can do. Whereas with the limited company side of things, you could pay yourself a combination of salary and dividends and get to that 50k mark, and then the additional you could leave in the company, and whatever you leave in the company is only going to be taxed at that 19% rate as opposed to the 40%. So it's still taxed, but it's obviously much lower. So that's probably the point in which you want to start considering making that switch.
No, that's really handy, because again, that's a question I get asked a lot of the time, because some people are doing very well with their businesses and they're like, okay, maybe it's time to switch, but I actually don't know when I should be switching.
And it also comes down to your lifestyle and how much you need to live on. Because if you need all of the income, then staying as a sole trader is probably okay, even past that 50k mark, because you'd just be withdrawing it all from the company anyway, and there'd be nothing left in it. So it's really a case of when you know you're earning a significant amount more than what you actually need, that's when it becomes quite valuable having the company set up.
That's really handy as well. And I guess another thing that I've definitely learned in the last couple of years, which is why I'm not yet a limited company, is buying a property as well as a sole trader can sometimes be a little bit easier, in the sense that you can pay yourself more than if you were like a limited company. Because I know some people only pay themselves £12,000 as when they're an owner of a limited company, which, as we know, is not enough to buy a property in the UK.
Nowhere near enough. It is another consideration. It makes it difficult to be tax efficient when you are trying to buy a property, because you have to make sure that you kind of have to do the backwards maths of, if this is the amount that you need, what does the income need to be if the multiplier is 5 or 4.5? So it's making sure that you hit that mark, really.
And there's a lot to consider always, isn't there?
Always, with everything they make you think.
So, a lot of people I know listen to this podcast as well and are self-employed, which is why I kind of wanted to ask a couple more questions. Again, as we approach the end of the tax year, what are some expenses that self-employed individuals may be able to claim?
So I think the key thing is firstly understanding what exactly counts as an expense and what doesn't. So the key buzzwords that you might hear that you need to remember are wholly and exclusively. This means that any expense needs to be wholly and exclusively for the purpose of running your business. That's, any marketing costs, equipment, office equipment, those kinds of things. The other key thing is like work from home costs. A lot of people miss. If you're operating and working mostly from home, then you can take a portion of your rent, bills, phone bills, internet, and pass that through as expenses against your profits to then reduce your taxable earnings, and then obviously your tax bill as well. And the other thing would be mileage. So for the first 10,000 miles that you travel each year, you can deduct 45 pence per mile and can write that off against your tax bill again. So it's handy to know those things.
Yeah, definitely, because I think when you're running a business, expenses can really, really rack up. And I think a lot of people forget that they can actually claim that against their business. I've got a question for you, Tim, because you are an accountant. How far can we take networking dinners and drinks?
It's the thing is that you need to be able to provide commercial justification. So if you're it depends who you're hosting the dinner for. Give me a scenario and we'll break it down.
Okay, let's say I have met someone on LinkedIn, might be a prospective client. I've decided to take them out for dinner so we can chat about how we can potentially work together.
Allowable.
Okay.
Yes.
What if some of us influencers decide to get together, go out for drinks on a Friday night?
Not allowable. No. Pushing it out too far.
Okay.
I think the key is just making sure that you're being sensible with it. And if you can provide a commercial justification as to how this could actually help your business in the future, then that's great. if it's just a meet up with friends, really, like a glorified meet up,
Yeah.
then we can't pass that through. But, you know, we can push it
Yeah.
reasonably far and,
Yeah.
and say that, you know, if you are networking for the sake of being an influencer, you're attending events, travel, expenses whilst you're there, it can be deducted.
No, okay, that's really handy because again, I think sometimes there's some blurred lines.
There
and I
are.
wanted to clear that up. But obviously, there's probably a lot of mistakes people make as we head towards the end of this tax year. And obviously, because people listen to this podcast, they don't want to make those mistakes. So what are some common mistakes you encounter as an accountant, and how can they avoid them?
I think the first thing is, like you touched on earlier, not tracking your expenses. So, you know, a lot of people, they think they know how much they're making and how much they're spending, but they
Yeah.
actually don't, because they're genuinely just not tracking it. And a lot of that will also come down to the fact that they don't have things in a separate business account compared to personal account. If you run everything through your personal account, it's a recipe for disaster,
Yeah.
and it's going to make your accountant's life hell when they're trying to, you know, decipher through thousands of transactions. So don't do that.
Yeah.
But yeah, it's really a case of making sure that you're on top of the numbers, because business owners are so busy and they've got no time to keep on top of things. But
Yeah.
when it comes to things like expenses, your earnings, your profit, you really do need to make sure that you have a roughly good idea of what's coming in and what's going out. The same with your personal finances.
Yes.
You know, when it comes to your living costs, you know, you need to know roughly if you can survive with the current kind of the amount that you're spending,
Yeah.
if it's sustainable. And it's the same with the business. It needs
Yeah.
to be sustainable.
Yeah, no, I agree. And I guess another thing I would add is to do your research and be aware of these different allowances that we kind of touched on, because like I mentioned, the tax year goes so quickly and before you know it, you're like, oh my gosh, I've still got a £20,000 allowance, I've not maximised it. So I think it's really important that as we go into at least the next tax year, to again refresh your memory, remind yourself, okay, what are these allowances that I can take advantage of, because again, we don't want to be paying the tax man more money than we need to.
No one wants that. They get enough as it is.
Exactly. More than enough. But Tim, before we round up today's episode, do you have any final top tips for those looking to navigate the end of the tax year? Yeah.
The final thing I would say is, for any business owners out there, if you're looking to take a dividend between now and the 5th of April,
Yeah.
wait until the 6th of April, because you're going to defer any tax liability by an entire year just by
Okay.
waiting until the new tax year starts. So if you took it now, it would be due in Jan 2026.
Okay.
If you wait, it will then be due in Jan 2027.
Ooh.
So if you can last the extra, you know, few weeks, then wait, because
Yeah.
you're going to save yourself some tax liability.
And this is why we have you, the accountant, on the podcast, because I did not know that myself.
There you go.
Well, thank you so much, Tim, for being a guest on the podcast today. You've shared amazing gems of knowledge that I needed to know as a reminder, and probably you guys listening at home needed to as well. Obviously, you're an accountant and you offer accountancy services as well as create great content. So where can people find you just to either enjoy your content or actually seek your accountancy services?
Yes, the amount of handles I've got are racking up now. So it's _ Tim Paul on Instagram, Temper Time on TikTok,
Yeah.
and then Team B Accounting or Tim Paul Accounting on Instagram for my accountancy practice.
Amazing. Well, thank you very much, Tim.
Thank you for having me.